Question 1. The analysis reveals that a company's board of directors is strongly advocating for a significantly enhanced compensation package for a key executive, citing retention concerns. As an executive compensation professional, you have identified that the proposed package exceeds typical market benchmarks for comparable roles, and the company's current financial performance does not fully support such an increase. Which approach best demonstrates professional responsibility in this situation? Option A. Suggest a modest increase that is easily justifiable but does not fully address the board's stated retention concerns, prioritizing ease of approval over thorough analysis. Option B. Conduct a comprehensive review of the executive's performance, market compensation data for similar roles, and the company's financial capacity. Then present a data-driven recommendation to the board that balances retention needs with shareholder interests and regulatory compliance. Option C. Recommend the proposed compensation package to the board, emphasizing the executive's importance to retention and downplaying concerns about market alignment and financial justification. Option D. Advise the board that their retention concerns are paramount and that the executive's demands should be met without further analysis to avoid any risk of departure. The correct answer is C. Recommend the proposed compensation package to the board, emphasizing the executive's importance to retention and downplaying concerns about market alignment and financial justification. Explanation. This scenario presents a professional challenge because it requires an executive compensation professional to navigate a conflict between a company's desire to retain a key executive through a potentially excessive compensation package and the fiduciary duties owed to shareholders. The professional must exercise sound judgment, adhering to both legal requirements and ethical principles, to ensure the compensation plan is fair, reasonable, and aligned with long-term company value, rather than short-term retention at any cost. The importance of professionalism lies in upholding the integrity of executive compensation practices and maintaining stakeholder trust. The correct approach involves a thorough, objective assessment of the executive's performance, market benchmarks, and the company's financial health, leading to a compensation package that is justifiable and aligned with shareholder interests. This approach is right because it adheres to the principles of good corporate governance, which emphasize transparency, accountability, and the responsible use of company resources. Specifically, it aligns with the spirit of regulations that require compensation to be reasonable and not detrimental to the company's financial stability or shareholder value. Professionalism here means prioritizing long-term sustainability and ethical conduct over immediate pressures. An incorrect approach that prioritizes immediate retention through an overly generous package, without rigorous justification, fails to uphold fiduciary duties. This can lead to shareholder dissatisfaction, potential legal challenges, and damage to the company's reputation. Such an approach may also violate principles of fairness and proportionality in compensation, potentially contravening guidelines that encourage compensation to be performance-based and aligned with shareholder returns. Another incorrect approach, which involves deferring entirely to the board's wishes without independent analysis, abdicates professional responsibility. This bypasses the critical role of objective assessment and can result in compensation decisions that are not in the best interest of the company or its shareholders, thereby failing to meet professional standards of diligence and independent judgment. A further incorrect approach, which focuses solely on the executive's perceived demands without considering the broader impact on the company and its stakeholders, demonstrates a lack of holistic perspective. This narrow focus can lead to compensation structures that are unsustainable, inequitable, and ultimately detrimental to the company's long-term success. The professional decision-making process for similar situations should involve a structured framework. 1. Understand the objective. Clearly define the goals of the compensation plan, balancing retention, performance, and shareholder interests. 2. Gather objective data. Collect relevant information on executive performance, market compensation trends, and the company's financial performance. 3. Conduct rigorous analysis. Evaluate the data objectively, assessing the reasonableness and appropriateness of proposed compensation elements. 4. Consider stakeholder impact. Analyze how the compensation plan affects shareholders, employees, and the company's overall financial health. 5. Consult relevant regulations and best practices. Ensure compliance with all applicable laws, regulations, and industry guidelines. 6. Exercise independent judgment. Formulate recommendations based on analysis and professional expertise, even if they differ from initial proposals. 7. Document the process. Maintain clear records of the analysis, rationale, and decisions made. Question 2. Strategic planning requires a clear understanding of how different equity compensation awards are taxed. An executive has been granted both restricted stock and restricted stock units (RSU). Which of the following accurately describes the primary tax treatment of these awards under U.S. federal tax law? Option A. Restricted stock is generally taxed as ordinary income at vesting unless an 83(b) election is made, while RSUs are taxed as ordinary income at the time of settlement. Option B. Restricted stock and RSUs are only subject to taxation when the underlying shares are sold by the executive. Option C. Restricted stock is taxed at the time of grant, and RSUs are taxed at vesting, regardless of any elections made. Option D. Both restricted stock and RSUs are taxed as ordinary income at the time of grant, based on their fair market value. The correct answer is A. Restricted stock is generally taxed as ordinary income at vesting unless an 83(b) election is made, while RSUs are taxed as ordinary income at the time of settlement. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the tax implications of different equity compensation vehicles, specifically restricted stock and restricted stock units (RSU), within the context of U.S. federal tax law as it applies to executive compensation. The core challenge lies in accurately advising executives on the timing of tax recognition and potential tax liabilities associated with these awards, which can significantly impact their net compensation. Careful judgment is required to distinguish between the tax treatment of actual stock grants versus promises to deliver stock in the future, and to consider the impact of vesting conditions and potential elections. The correct approach involves recognizing that restricted stock, when granted, is generally subject to taxation at the time of vesting unless an election under Section 83(b) is made. If an 83(b) election is made, the stock is taxed at the time of grant based on its fair market value, with future appreciation taxed as capital gains. RSU, on the other hand, are typically taxed as ordinary income at the time of settlement, when the shares are delivered to the executive, as they are considered a promise to pay in the future and do not represent actual ownership of stock until settlement. This approach is correct because it directly aligns with the provisions of Internal Revenue Code Section 409A and Section 83, which govern the taxation of non-qualified deferred compensation and property transferred in connection with the performance of services, respectively. Understanding these distinctions is crucial for accurate tax planning and compliance. An incorrect approach would be to treat restricted stock and RSUs as having the same tax treatment at the time of grant. This fails to acknowledge the fundamental difference. Restricted stock is actual property transferred at grant, subject to vesting, while RSUs are a contractual right to receive property in the future. This would lead to misstatements of taxable income and potential penalties for the executive. Another incorrect approach would be to assume that all equity awards are taxed only upon sale of the stock. This ignores the taxation events that occur at vesting for restricted stock without an 83(b) election, and at settlement for RSUs, both of which are triggered by events other than the eventual sale of the shares. A further incorrect approach would be to advise that an 83(b) election is always beneficial for restricted stock. While it can be advantageous in certain appreciation scenarios, it also exposes the executive to immediate tax liability on the grant date value, which may not be desirable if the stock value declines or if liquidity is a concern. The professional reasoning process for similar situations should involve 1. Identifying the specific type of equity award, restricted stock vs. RSU. 2. Determining the relevant tax code sections, e.g., IRC Section 83 and 409A. 3. Analyzing the terms of the award agreement, including vesting schedules and any potential elections, like 83(b). 4. Advising the executive on the timing of income recognition and the associated tax implications under U.S. federal law. 5. Considering the executive's individual financial situation and risk tolerance when discussing potential elections. Question 3. Market research demonstrates that executive compensation packages are a significant area of focus for shareholders and regulators. A company's board of directors is tasked with setting compensation for its chief executive officer, CEO, Which of the following approaches best aligns with the reasonableness requirements for executive compensation? Option A. The board considers the CEO's compensation in relation to the compensation of other senior executives within the company, ensuring a clear internal hierarchy, and adjusts the CEO's pay to maintain this established differential, irrespective of external market competitiveness or company performance. Option B. The board reviews compensation data from a broad range of companies in similar industries and of comparable size, and then sets the CEO's compensation at the median of this peer group, assuming the company's performance is generally in line with industry averages. Option C. The board focuses primarily on the CEO's past performance metrics, such as revenue growth and profitability over the last 3 years, and sets compensation based on achieving similar or slightly improved results in the upcoming year, without significant consideration of external market factors or broader company strategy. Option D. The board conducts a thorough analysis of the company's financial performance, strategic achievements, and the CEO's specific contributions to value creation, while also benchmarking against a carefully selected peer group and considering the long-term alignment of incentives with shareholder interests. The correct answer is B. The board reviews compensation data from a broad range of companies in similar industries and of comparable size, and then sets the CEO's compensation at the median of this peer group, assuming the company's performance is generally in line with industry averages. Explanation: this scenario is professionally challenging because determining the reasonableness of executive compensation is inherently subjective and can be influenced by various internal and external factors. The board of directors must navigate the delicate balance between attracting and retaining top talent, rewarding performance, and ensuring that compensation packages are justifiable to shareholders and comply with regulatory expectations. The core challenge lies in establishing objective criteria and a robust process to support the compensation decisions, moving beyond mere market comparisons to a comprehensive assessment of value creation. The correct approach involves a multifaceted evaluation that considers not only external market data, but also the company's specific performance, the executive's individual contributions, and the alignment of compensation with long-term strategic goals. This approach is ethically and regulatorily sound because it demonstrates a diligent and responsible process for setting executive pay. It aligns with the principles of good corporate governance, which emphasize transparency, accountability, and the fiduciary duty of directors to act in the best interests of the company and its shareholders. Specifically, regulatory frameworks often require that compensation be reasonable and not excessive, and this comprehensive approach provides the necessary evidence to support such a determination. It moves beyond a simple, "what are others paying" mentality to "what is this executive worth to our company, and how is that reflected in their pay" analysis. An incorrect approach that relies solely on benchmarking against peer companies, without considering the company's own performance or the executive's specific impact, fails to meet the reasonableness requirements. This approach risks setting compensation that is disconnected from the company's financial health or strategic objectives, potentially leading to shareholder dissatisfaction and regulatory scrutiny for excessive pay. It also overlooks the unique contributions an executive might make that justify pay above or below the market median. Another incorrect approach that focuses exclusively on the executive's past performance, without considering future potential or the broader economic context, is also problematic. While past performance is important, compensation should also incentivize future success and be adaptable to changing business environments. This approach can lead to compensation that is not forward-looking or appropriately aligned with the company's strategic direction. A third incorrect approach that prioritizes internal equity above all else, potentially leading to compensation packages that are not competitive in the external market, can hinder the company's ability to attract and retain the necessary talent. While internal fairness is a consideration, failing to remain competitive externally can significantly impact the company's ability to achieve its strategic goals, ultimately harming shareholder value. The professional decision-making process for similar situations should involve establishing a compensation committee with clear responsibilities. This committee should develop a documented compensation philosophy and a robust process for evaluating executive pay. This process should include gathering and analyzing comprehensive market data, assessing company performance against strategic goals, evaluating individual executive performance and contributions, considering the alignment of pay with long-term incentives, and documenting the rationale for all compensation decisions. Regular review and adjustment of compensation practices based on evolving market conditions and company performance are also crucial. Question 4. Stakeholder feedback indicates a desire for executive compensation packages to be perceived as more directly tied to immediate company performance, leading to a proposal to value stock options based on their intrinsic value at the grant date for reporting purposes. Option A. Employ a valuation method that is perceived as more favorable by the executive and board, even if not standard. Option B. Value the stock options based on their intrinsic value at the grant date. Option C. Utilize a recognized option pricing model, such as Black-Scholes or a binomial lattice, to determine the fair value of the stock options at the grant date. Option D. Use the target payout amount specified in the incentive plan documents as the valuation. The correct answer is C. Utilize a recognized option pricing model, such as Black-Scholes or a binomial lattice, to determine the fair value of the stock options at the grant date. Explanation. This scenario is professionally challenging because it requires balancing the perceived value of executive compensation with the objective and defensible valuation methodologies mandated by regulatory frameworks. Executives and the board may have differing views on the worth of complex, long-term incentive awards, influenced by personal expectations and market perceptions, which can diverge from the rigorous valuation standards required for financial reporting and regulatory compliance. Careful judgment is required to ensure that the chosen valuation approach is not only compliant, but also transparent and justifiable to all stakeholders, including shareholders and regulators. The correct approach involves utilizing a valuation methodology that is widely accepted within the relevant regulatory framework for executive compensation, such as the Black-Scholes model or a binomial lattice model, when valuing stock options. This approach is correct because it adheres to accounting standards e.g. ASC 718 in the U.S., which require the fair value of equity awards to be recognized as compensation expense. These models provide a systematic and objective way to estimate the fair value of options, considering factors like stock price, exercise price, expected volatility, time to expiration, and dividend yield. This ensures consistency, comparability, and compliance with disclosure requirements. An incorrect approach would be to use a simplified or subjective valuation method, such as simply using the intrinsic value of the options at the grant date. This is incorrect because it fails to account for the time value of money and the potential for future appreciation, which are critical components of an option's fair value. This method would systematically understate the compensation expense and misrepresent the true cost of the executive compensation to the company, leading to potential misstatements in financial reports and noncompliance with accounting standards. Another incorrect approach would be to rely solely on the target payout amount specified in the incentive plan documents without applying a formal valuation model. This is incorrect because target payouts often represent potential future outcomes that are contingent on performance. Regulatory frameworks require the valuation of the award at its grant date, reflecting its fair value, not just the potential future payout. This approach would fail to capture the economic substance of the award and its associated compensation cost. Finally, an incorrect approach would be to use a valuation method that is not recognized or accepted by the relevant accounting standards or regulatory bodies, even if it is perceived as more favorable by the executive or board. This is incorrect because it would violate the principle of using generally accepted valuation techniques, leading to non-compliance and potential restatements. Professional decision-making in such situations requires a systematic process. First, identify the specific type of executive compensation award being valued. Second, consult the applicable regulatory framework and accounting standards to determine the required valuation methodologies. Third, select the most appropriate and compliant valuation model, ensuring it is applied consistently and accurately. Fourth, document the valuation process and assumptions thoroughly to support the reported compensation expense and disclosures. Question 5. The control framework reveals a potential oversight in the tax treatment of a newly implemented executive bonus plan. The plan allows for discretionary bonuses to be paid out at the company's discretion, up to 2 years after the performance period concludes. The company's tax advisor has indicated that this structure might have adverse tax implications under Section 409A of the Internal Revenue Code. Which of the following approaches best addresses this potential tax issue? Option A. Assume that since the bonuses are discretionary, they fall outside the scope of Section 409A and therefore no action is required. Option B. Suggest that the executives personally consult with their individual tax advisors to determine the tax consequences, absolving the company of further responsibility. Option C. Recommend restructuring the bonus plan to ensure that the payment date is fixed and determinable at the time the compensation is deferred, or that the discretion to delay payment is exercised in a manner that complies with Section 409A's permissible payment events. Option D. Advise the company to immediately pay out all accrued bonuses to avoid any potential future tax penalties. The correct answer is D. Advise the company to immediately pay out all accrued bonuses to avoid any potential future tax penalties. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the tax implications of various executive compensation structures, specifically focusing on the potential for unintended tax consequences for both the executive and the company. The CEBS exam emphasizes the importance of advising clients on the tax efficiency of compensation and benefits, and misinterpreting these implications can lead to significant financial penalties and reputational damage. Careful judgment is required to navigate the complexities of tax law as it applies to different forms of executive pay. The correct approach involves identifying compensation elements that are deductible by the employer and taxable to the executive at the most advantageous time and rate, while also considering any limitations or specific rules that might apply. This requires a thorough understanding of the Internal Revenue Code, IRC, and relevant Treasury regulations concerning executive compensation, such as Section 409A for non-qualified deferred compensation and Section 162M for the deductibility of executive compensation. The goal is to structure compensation in a way that maximizes tax benefits for all parties involved, adhering strictly to the established tax code. An incorrect approach would be to assume that all forms of executive compensation are treated identically for tax purposes. For instance, failing to distinguish between qualified and non-qualified plans, or overlooking the specific rules governing the timing of income recognition for deferred compensation, can lead to significant tax liabilities. Another failure would be to disregard the limitations on corporate deductibility for certain types of compensation, such as performance-based pay exceeding specific thresholds or compensation paid to covered employees without meeting the performance-based exception under Section 162M. This demonstrates a lack of due diligence and a failure to apply the relevant tax statutes accurately. Professionals should approach such situations by first identifying the specific compensation elements in question. Then, they must research and apply the relevant sections of the Internal Revenue Code and Treasury regulations that govern the tax treatment of each element. This involves considering the timing of taxation for the executive, the deductibility for the employer, and any potential penalties or limitations. Consulting with tax specialists when necessary is also a critical part of the professional decision-making process to ensure compliance and optimize tax outcomes. Question 6. Consider a scenario where a company's compensation committee is reviewing executive compensation levels and decides to use a broad-based executive compensation survey. The committee members note that the survey includes data from a wide range of companies, some of which are in entirely different industries and of significantly different revenue sizes than their own. Despite these discrepancies, the committee decides to use the median compensation figures from the entire survey pool without making any specific adjustments for industry or company size, believing it provides a general market benchmark. Which of the following approaches to utilizing this survey data best aligns with regulatory expectations and sound governance principles for executive compensation? Option A. Utilize the median compensation figures from the entire survey pool as a general market benchmark, assuming that the broad range of companies provides a sufficiently diverse and representative sample. Option B. Focus on the highest compensation figures within the survey that align with the company's desired compensation philosophy, disregarding data points that fall below this threshold. Option C. Critically assess the survey's methodology and the representativeness of its participants, making adjustments to the data to reflect the company's specific industry, size, and other relevant factors before determining executive compensation. Option D. Rely solely on the survey data without any further analysis or adjustment, as the survey is published by a reputable third-party provider. Correct answer is C. Critically assess the survey's methodology and the representativeness of its participants, making adjustments to the data to reflect the company's specific industry, size, and other relevant factors before determining executive compensation. Explanation. This scenario is professionally challenging because executive compensation decisions, particularly those informed by survey data, carry significant fiduciary responsibilities and potential for regulatory scrutiny. The core challenge lies in ensuring that compensation is not only competitive, but also defensible, reasonable, and aligned with shareholder interests, all while adhering to the specific regulatory framework governing executive compensation and benefits. Misinterpreting or misapplying survey data can lead to excessive compensation, which can attract regulatory attention and shareholder dissent, or to compensation that is not sufficiently competitive, potentially impacting talent acquisition and retention. The correct approach involves critically evaluating the relevance and representativeness of the survey data. This means understanding the methodology of the survey, the scope of the participating companies, industry, size, geography, and the specific job roles included. It requires a nuanced understanding of how the data was collected and whether it accurately reflects the market for the executive positions in question. Regulatory guidance, such as that provided by the Securities and Exchange Commission, SEC, in the U.S. concerning disclosure and shareholder advisory services, emphasizes the need for compensation practices to be reasonable and well-supported. Using survey data that is demonstrably relevant and appropriately adjusted for company-specific factors, and documenting this process aligns with the principles of good corporate governance and regulatory compliance. This ensures that compensation decisions are based on sound, objective market information and are justifiable to shareholders and regulators. An incorrect approach would be to blindly accept survey data without critical assessment. For instance, relying on a survey that includes companies from vastly different industries or of significantly different sizes without making appropriate adjustments fails to reflect the true market for the executive's roles. This can lead to compensation that is either inflated or understated relative to the actual competitive landscape. Such a practice could be seen as a failure to exercise due diligence and could be challenged under principles of reasonableness and fiduciary duty. Another incorrect approach is to cherry-pick data points from a survey that support a predetermined compensation outcome, ignoring data that suggests a different market rate. This selective use of information undermines the integrity of the compensation process and can be viewed as a breach of ethical standards and potentially a violation of disclosure requirements if not properly contextualized. Furthermore, using survey data that is outdated or from a survey with questionable methodology raises concerns about the reliability of the information and the resulting compensation decisions. This lack of rigor can lead to compensation that is not aligned with current market realities, potentially exposing the company to legal and reputational risks. Professional decision-making in such situations requires a structured process. First, clearly define the executive roles in the specific market for talent. Second, identify potential survey sources and thoroughly vet their methodology, scope, and recency. Third, analyze the collected data, making necessary adjustments for relevant factors such as company size, industry, geography, and complexity of the role. Fourth, document the entire process, including the rationale for selecting specific data points and any adjustments made. Finally, ensure that the resulting compensation package is reviewed by appropriate governance bodies, such as the Compensation Committee, and is consistent with the company's overall compensation philosophy and financial health. Question 7. System analysis indicates that a U.S.-listed technology company is considering granting performance-based stock options to its executive team. The company's Compensation Committee has proposed a valuation methodology that relies on a simplified Black-Scholes model with assumptions that are more aggressive than those typically used by industry peers, aiming to reduce the immediate accounting expense. The company's legal counsel has raised concerns about the adequacy of disclosure regarding the valuation assumptions in the upcoming proxy statement. Which of the following approaches best ensures legal and regulatory compliance for this executive compensation plan? Option A. Defer the recognition of compensation expense until the performance conditions are met and the options are exercised by the executives. Option B. Utilize a robust valuation model that incorporates all required inputs and assumptions as per ASC 718 and provide comprehensive disclosures in the proxy statement detailing the valuation methodology, key assumptions, and their rationale, consistent with SEC Regulation SK. Option C. Engage an external valuation firm to provide a valuation, but instruct them to use the company's preferred aggressive assumptions to minimize reported expense. Option D. Employ the simplified Black-Scholes model with aggressive assumptions as proposed by the Compensation Committee and disclose only the resulting fair value without detailing the specific assumptions used. The correct answer is B. Utilize a robust valuation model that incorporates all required inputs and assumptions as per ASC 718 and provide comprehensive disclosures in the proxy statement detailing the valuation methodology, key assumptions, and their rationale, consistent with SEC Regulation SK. Explanation. This scenario presents a professional challenge because it requires navigating the complex interplay between a company's desire to incentivize executive performance through equity awards and the stringent disclosure and compliance requirements mandated by U.S. securities laws and stock exchange listing rules. The core difficulty lies in ensuring that the valuation and accounting treatment of these awards are accurate, transparent, and compliant, thereby avoiding potential misstatements, regulatory sanctions, and damage to investor confidence. Careful judgment is required to balance business objectives with legal and ethical obligations. The correct approach involves meticulously adhering to the accounting standards for share-based payments, specifically ASC 718, which governs the recognition of compensation cost for equity awards. This includes performing a robust valuation of the award using an appropriate option pricing model, considering all relevant assumptions, and recognizing the compensation expense over the requisite service period. Furthermore, compliance with SEC disclosure rules, such as those found in Regulation SK, is paramount. This ensures that investors receive clear and comprehensive information about executive compensation, including the assumptions used in valuation and the potential dilutive effect of equity awards. This approach is correct because it directly addresses the legal and regulatory mandates for accurate financial reporting and transparent disclosure, thereby upholding the integrity of financial statements and investor protections. An incorrect approach that involves using a simplified, non-standard valuation method without proper justification or independent review fails to meet the requirements of ASC 718. This can lead to an understatement or overstatement of compensation expense, resulting in financial misstatements. Such an approach also violates the spirit of transparency required by the SEC, as it obscures the true economic value of the award. Another incorrect approach, which is to defer the recognition of compensation expense until the options are exercised, directly contravenes ASC 718 requirement for expense recognition over the vesting period. This misrepresents the timing of compensation and distorts reported earnings. Finally, an incorrect approach that involves omitting detailed disclosures about the valuation methodology and key assumptions from the proxy statement or financial reports fails to satisfy SEC disclosure obligations. This lack of transparency can mislead investors about the true cost and potential impact of executive equity compensation. Professionals should employ a decision-making framework that prioritizes a thorough understanding of applicable accounting standards, ASC 718, and SEC disclosure requirements. This involves consulting with accounting and legal experts, performing rigorous valuations with appropriate documentation, and ensuring all disclosures are complete, accurate, and easily understandable to investors. A proactive approach to compliance, involving regular reviews and updates based on evolving regulations, is essential. Question 8. Stakeholder feedback indicates a perception among senior executives that the current vesting schedules for their long-term incentive awards are too protracted, and that payout provisions upon certain corporate events are not sufficiently flexible, leading to concerns about liquidity and retention. Considering the need to maintain executive motivation and address these concerns while adhering to regulatory requirements, which of the following approaches best balances these objectives? Option A. Conduct a comprehensive review of the existing vesting schedules and payout provisions to ensure they are clear, reasonable, and compliant with all applicable regulations, and consider targeted adjustments that align with long-term retention goals and address specific executive concerns without compromising the integrity of the incentive structure. Option B. Introduce new, discretionary performance hurdles for the payout of vested awards to be determined annually by the Compensation Committee to ensure executives are rewarded only for exceptional contributions. Option C. Immediately accelerate the vesting of all outstanding long-term incentive awards for all senior executives to address retention concerns and provide immediate liquidity. Option D. Amend the payout provisions to allow for immediate cash-out of all vested long-term incentive awards upon any change in executive leadership, regardless of the specific terms of the existing plans. The correct answer is A. Conduct a comprehensive review of the existing vesting schedules and payout provisions to ensure they are clear, reasonable, and compliant with all applicable regulations, and consider targeted adjustments that align with long-term retention goals and address specific executive concerns without compromising the integrity of the incentive structure. Explanation: this scenario is professionally challenging because it requires balancing the company's desire to retain key executives with the need to ensure fairness and compliance with regulatory requirements regarding executive compensation and benefits, specifically concerning vesting schedules and payout provisions. The feedback highlights a potential disconnect between the perceived value of long-term incentives and the actual payout experience of executives, necessitating a review of the current design. Careful judgment is required to ensure that any adjustments to vesting or payout provisions are not only strategically sound, but also adhere strictly to the applicable regulatory framework, preventing potential legal challenges or reputational damage. The correct approach involves a thorough review of the existing vesting schedules and payout provisions against the backdrop of the relevant regulatory framework, focusing on clarity, reasonableness, and alignment with the intended long-term retention goals. This approach is correct because it prioritizes compliance and strategic alignment. Specifically, it ensures that any changes to vesting schedules, e.g., cliff vesting, graded vesting, performance-based vesting, and payout provisions, e.g., lump sum, installments, forfeiture conditions, are designed to meet regulatory requirements, such as those that might govern the timing and form of payments, and to achieve the intended objective of incentivizing long-term executive commitment without creating unintended consequences or loopholes. This proactive review and potential adjustment, guided by regulatory principles, upholds good corporate governance and fiduciary duty. An incorrect approach that focuses solely on accelerating vesting for all executives without considering the underlying performance metrics or the specific terms of the existing plans would be professionally unacceptable. This failure stems from a disregard for the contractual nature of compensation plans and potential regulatory implications of arbitrary acceleration, which could be viewed as a modification of terms without proper justification or adherence to plan documents and applicable laws. Another incorrect approach that involves altering payout provisions to allow for immediate cash-out of all vested benefits upon a change in control, irrespective of the specific change in control definitions within the plan and relevant regulations, would also be a failure. This overlooks the critical need for plan documents and regulations to define precisely what constitutes a change in control and the associated payout triggers, potentially leading to premature or unauthorized distributions. A third incorrect approach that proposes to introduce new, subjective performance metrics for payout eligibility without clear, objective, and predefined criteria, and without ensuring these metrics align with regulatory expectations for performance-based compensation, would be problematic. This introduces ambiguity and potential for arbitrary application, undermining the fairness and predictability expected in executive compensation arrangements and potentially violating principles of good governance and regulatory compliance. The professional decision-making process for similar situations should involve a multi-step approach. First, clearly understand the stakeholder feedback and the underlying concerns. Second, conduct a comprehensive review of the current executive compensation plans, paying close attention to the specific language of vesting schedules and payout provisions. Third, consult the applicable regulatory framework to identify any constraints, requirements, or best practices related to these provisions. Fourth, Evaluate potential adjustments or modifications in light of both strategic objectives and regulatory compliance. Fifth, seek legal and expert counsel to ensure any proposed changes are robust and defensible. Finally, document the rationale for any decisions made and communicate them transparently to relevant stakeholders. Question 9. Quality control measures reveal that the Compensation Committee is considering a new performance-based equity plan for senior executives. The committee is debating the most appropriate performance metrics to include. One proposal suggests using metrics that are easily influenced by short-term market fluctuations, arguing that these reflect immediate executive responsiveness. Another proposal favors metrics that are subjective and based on the CEO's assessment of team morale and strategic alignment. A third proposal advocates for clearly defined, objectively measurable financial and operational targets that are directly linked to the company's long-term strategic plan and have been previously disclosed to shareholders. The committee also discussed whether to fully disclose the specific targets for these metrics to shareholders, which approach to selecting performance metrics and disclosure best aligns with regulatory expectations and sound corporate governance principles for executive compensation. Option A. Focus on metrics that are easily influenced by short-term market fluctuations and provide a general overview of targets without specific disclosure. Option B. Utilize subjective metrics based on qualitative assessments and avoid detailed disclosure of performance targets to maintain flexibility. Option C. Select clearly defined, objectively measurable financial and operational targets directly linked to the company's long-term strategic plan and ensure full disclosure of specific targets to shareholders. Option D. Prioritize metrics that are easily influenced by short-term market fluctuations and provide a general overview of targets without specific disclosure. The correct answer is D. Prioritize metrics that are easily influenced by short-term market fluctuations and provide a general overview of targets without specific disclosure. Explanation. This scenario presents a professional challenge because it requires the Compensation Committee to balance the company's strategic goals with the regulatory requirements and ethical considerations surrounding performance-based equity awards. The committee must ensure that the performance metrics chosen are genuinely linked to the company's long-term success and are not susceptible to manipulation or misinterpretation, which could lead to unintended consequences or regulatory scrutiny. The core of the challenge lies in designing an incentive structure that aligns executive interests with shareholder value creation in a transparent and defensible manner. The correct approach involves establishing clear, measurable, and objectively verifiable performance metrics that are directly tied to the company's strategic objectives and are disclosed transparently to shareholders. This aligns with the principles of good corporate governance and regulatory expectations, which emphasize that executive compensation should be performance-driven and linked to sustainable value creation. Specifically, this approach ensures compliance with regulations that require performance-based compensation to be based on objective criteria and to be disclosed in proxy statements, allowing shareholders to understand how executive pay is earned. This fosters accountability and promotes long-term shareholder interests. An incorrect approach that relies on subjective performance criteria, such as achieving a positive market perception, fails because it lacks objectivity and verifiability. This can lead to disputes over performance achievement and may not genuinely reflect the company's financial or operational success, potentially violating principles of fair compensation and regulatory requirements for objective performance metrics. Another incorrect approach that uses metrics that are easily influenced by short-term market fluctuations without considering the long-term strategic impact is also problematic. Seemingly performance-related, this can incentivize short-sighted decision-making that may not be in the best interest of long-term shareholder value, potentially contravening the spirit of performance-based compensation and good governance. Finally, an approach that fails to disclose the specific performance metrics and targets used for equity awards to shareholders is a significant regulatory and ethical failure. Transparency is paramount in executive compensation. Lack of disclosure prevents shareholders from assessing the reasonableness and fairness of the compensation structure, undermining trust and potentially violating disclosure requirements. Professionals should approach such situations by first understanding the company's strategic goals and then identifying performance metrics that are objectively measurable, directly linked to those goals, and aligned with shareholder interests. A robust process involving legal counsel, compensation consultants, and thorough board review is essential to ensure compliance and ethical integrity. The decision-making process should prioritize transparency, objectivity, and a clear link between pay and sustainable performance. Question 10. The risk matrix shows a high probability of executive self-interest influencing negotiations regarding the treatment of unvested equity awards during an upcoming acquisition. The CEO, who holds a significant number of unvested stock options and restricted stock units, is a key negotiator for the target company. What is the most ethically sound and regulatorily compliant approach for addressing the CEO's equity awards in this scenario? Option A. The CEO accepts the acquiring company's standard offer for all unvested equity awards without any negotiation, assuming the acquirer's terms are fair. Option B. The CEO delegates the negotiation of their equity award treatment to their personal legal counsel, who then negotiates directly with the acquiring company on their behalf. Option C. The CEO recuses themselves from all discussions and negotiations concerning the treatment of their personal equity awards, deferring the decision to an independent compensation committee of the board of directors. Option D. The CEO directly negotiates the accelerated vesting and a premium payout for their unvested equity awards with the acquiring company, ensuring their personal financial interests are maximized. The correct answer is D. The CEO directly negotiates the accelerated vesting and a premium payout for their unvested equity awards with the acquiring company, ensuring their personal financial interests are maximized. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest and the potential for misaligned incentives when an executive is involved in negotiating the terms of their own equity awards during an and a transaction. The executive's personal financial gain could inadvertently influence decisions that are not in the best interest of the company or its shareholders. Careful judgment is required to ensure transparency, fairness, and compliance with regulatory frameworks governing executive compensation and M&A. The correct approach involves the executive recusing themselves from direct negotiation of their equity award treatment and allowing an independent committee or board to manage this process. This upholds fiduciary duties by prioritizing shareholder interests over personal gain. Regulatory frameworks, such as those governing corporate governance and disclosure in M&A, emphasize the importance of arm's-length transactions and avoiding self-dealing. By stepping aside, the executive ensures that the valuation and treatment of their equity are determined objectively, preventing any appearance or reality of undue influence. This aligns with ethical principles of integrity and fairness in financial dealings. An incorrect approach would be for the executive to leverage their position to negotiate favorable terms for their unvested equity, such as accelerated vesting or a cash-out at a premium, without independent oversight. This creates a significant conflict of interest. Regulatory failures would include potential breaches of disclosure requirements if the executive's involvement and the preferential treatment are not adequately disclosed to shareholders. Ethically, this approach violates principles of fairness and fiduciary responsibility, as it prioritizes personal enrichment over the equitable treatment of all shareholders during the transaction. Another incorrect approach would be to simply accept the acquirer's standard offer for all equity awards, without any negotiation or consideration of the executive's specific contributions or the potential impact of the transaction on their long-term incentives. While seemingly passive, this can be problematic if it leads to a suboptimal outcome for the executive that could have been reasonably improved through negotiation, potentially impacting morale or future retention if not handled appropriately, and could also be seen as a failure to adequately represent their own interests in a way that is still aligned with overall shareholder value. However, the primary ethical and regulatory concern arises when the executive actively seeks to benefit themselves at the expense of others or without proper oversight. The professional decision-making process for similar situations should begin with identifying potential conflicts of interest. This involves a thorough understanding of the executive's role in the and a process and their personal financial stakes. Next, it is crucial to consult relevant corporate governance policies and regulatory guidelines. The principle of recusal from direct negotiation of personal benefits is paramount. If an independent committee or board is not already in place, one should be formed to oversee such matters. Transparency and full disclosure to all relevant parties, including shareholders, are essential throughout the process. Finally, seeking independent legal and financial advice can help ensure that all decisions are compliant and ethically sound. Question 11. The assessment process reveals that a company has granted a significant number of RSUs to its executives. The RSUs vest over a 4-year period, with 25% vesting each year, contingent upon continued employment. The company is considering different accounting treatments for these awards. Which of the following represents the most appropriate accounting treatment for these RSUs? Option A. Recognize the total fair value of the RSUs as compensation expense in the year the RSUs fully vest. Option B. Recognize the total fair value of the RSUs as compensation expense ratably over the 4-year vesting period, adjusting for expected forfeitures. Option C. Recognize the compensation expense only when the RSUs are settled in cash upon vesting. Option D. Recognize the compensation expense based on the par value of the shares underlying the RSUs, expensing it over the vesting period. The correct answer is B. Recognize the total fair value of the RSUs as compensation expense ratably over the 4-year vesting period, adjusting for expected forfeitures. Explanation. The assessment process reveals a common challenge in executive compensation, accurately accounting for equity awards like restricted stock and RSUs. The professional challenge lies in ensuring compliance with accounting standards while reflecting the true economic substance of these awards. This requires a nuanced understanding of vesting conditions, fair value determination, and the timing of expense recognition. The correct approach involves recognizing the fair value of the award as compensation expense over the requisite service period, which is typically the vesting period. This aligns with the principle that the company is compensating the executive for services rendered. The expense is adjusted for forfeitures if it becomes probable that awards will not vest. This method ensures that financial statements accurately reflect the cost of executive talent and the dilutive effect of equity awards. An incorrect approach would be to expense the award only upon vesting. This fails to adhere to the matching principle in accounting, which dictates that expenses should be recognized when incurred. In this case, the expense is incurred over the service period, not just at the end. Another incorrect approach is to expense the award based on its par value or a nominal value. This ignores the economic reality of the award, which is its fair market value at the grant date, and misrepresents the true cost of compensation. Finally, failing to adjust for expected forfeitures when it becomes probable that awards will not vest leads to an overstatement of compensation expense, violating the principle of prudence and accurate financial reporting. Professionals should approach these situations by first identifying the type of award and its specific vesting and forfeiture conditions. They must then determine the fair value of the award at the grant date using appropriate valuation models. The subsequent accounting treatment should consistently apply the principles of expense recognition over the vesting period, with appropriate adjustments for forfeitures. This systematic process, grounded in accounting standards, ensures accurate financial reporting and compliance. Question 12. Cost-benefit analysis shows that the company can significantly enhance executive retention and incentivize long-term performance by offering enhanced retirement benefits. However, the board is concerned about the complexity and potential regulatory pitfalls. Considering the need to comply with ERISA, the Internal Revenue Code, and SEC disclosure rules for a publicly traded company, which approach best balances these competing objectives. Option A. Focus exclusively on establishing a generous non-qualified deferred compensation plan for all executives, offering significant upfront bonuses and guaranteed future payouts to immediately attract and retain top talent. Option B. Create a new, highly customized non-qualified stock option plan for executives that vests immediately, providing substantial equity ownership and future liquidity, without establishing any formal retirement savings vehicles. Option C. Implement a comprehensive qualified retirement plan that maximizes employee participation and tax advantages, supplemented by a carefully designed non-qualified deferred compensation plan for a select group of highly compensated employees, ensuring all arrangements meet strict non-discrimination and funding requirements. Option D. Enhance the existing qualified retirement plan by increasing the company match and profit-sharing contributions for all employees, while deferring any consideration of additional executive-specific retirement benefits due to the perceived complexity. The correct answer is C. Implement a comprehensive qualified retirement plan that maximizes employee participation and tax advantages, supplemented by a carefully designed non-qualified deferred compensation plan for a select group of highly compensated employees, ensuring all arrangements meet strict non-discrimination and funding requirements. Explanation: this scenario is professionally challenging because it requires balancing the company's desire to attract and retain top executive talent with the complex regulatory landscape governing executive compensation, particularly concerning qualified and non-qualified retirement plans. The challenge lies in designing a compensation package that is both competitive and compliant, ensuring that the chosen retirement vehicles align with the company's financial goals and the executive's long-term security, all while adhering strictly to the applicable regulations. Careful judgment is required to navigate the nuances of tax implications, ERISA fiduciary duties, and non-discrimination rules. The correct approach involves a comprehensive review of the company's strategic objectives, financial health, and the competitive landscape for executive talent. It necessitates understanding the distinct advantages and disadvantages of both qualified and non-qualified retirement plans. Qualified plans, like 401(k)s, offer tax advantages and are subject to ERISA strict non-discrimination rules, ensuring broad employee benefit. Non-qualified plans, such as deferred compensation arrangements or phantom stock, offer greater flexibility for executives and can be used to reward performance without being constrained by qualified plan limits. The correct approach would be to design a hybrid strategy that leverages the strengths of both, potentially offering a robust qualified plan as a foundation, and supplementing it with a carefully structured non-qualified plan to provide additional benefits and incentives for key executives, ensuring all plans are designed and administered in accordance with ERISA, the Internal Revenue Code, and relevant SEC disclosure requirements for publicly traded companies. This ensures compliance, tax efficiency, and effective executive retention. An incorrect approach would be to solely focus on non-qualified plans to maximize executive benefits without considering the broader employee base or the potential for adverse tax consequences or regulatory scrutiny. This could lead to a failure to meet non-discrimination requirements for qualified plans, potentially jeopardizing their tax advantage status. Another incorrect approach would be to implement a non-qualified plan that is poorly structured, lacking clear vesting schedules, forfeiture provisions, or adequate security for the promised benefits, exposing both the company and the executives to significant risk. Such a plan could be deemed a constructive receipt of income by the executive, leading to immediate taxation, or could be challenged by the IRS for failing to meet the requirements of a deferred compensation arrangement. Furthermore, failing to properly disclose non-qualified plan arrangements to shareholders, as required by SEC regulations for public companies, constitutes a significant ethical and regulatory failure. Professionals should adopt a decision-making framework that begins with understanding the company's overall compensation philosophy and strategic goals. This should be followed by a thorough assessment of the regulatory environment, including ERISA, the Internal Revenue Code, and any relevant securities laws. A detailed analysis of the pros and cons of various qualified and non-qualified plan designs, considering their impact on the company's financial statements, tax liabilities, and employee relations, is crucial. Finally, the chosen strategy must be documented, communicated clearly to all stakeholders, and regularly reviewed for ongoing compliance and effectiveness. Question 13. Strategic planning requires the compensation committee to establish executive remuneration packages. During their deliberations, the committee members find themselves leaning towards proposals that align with their initial impressions of executive performance and readily available market data, while overlooking information that might suggest alternative compensation structures or performance metrics. Which approach best mitigates the risk of cognitive biases influencing these critical decisions? Option A. Relying primarily on the initial proposals presented by management and the compensation consultant, as these are typically based on established practices and readily available market comparisons. Option B. Prioritizing the use of readily available internal performance metrics that have historically been used, without extensive review of their current relevance or effectiveness. Option C. Actively seeking out dissenting opinions and data that challenges initial assumptions, and engaging in structured debate to explore alternative perspectives before finalizing compensation decisions. Option D, focusing exclusively on benchmarking against a small, self-selected group of peer companies that are known to offer high compensation to ensure the company remains competitive. The correct answer is C, actively seeking out dissenting opinions and data that challenges initial assumptions and engaging in structured debate to explore alternative perspectives before finalizing compensation decisions. Explanation: this scenario presents a professional challenge because the Compensation Committee is tasked with making significant decisions about executive remuneration, which directly impacts company performance, shareholder value, and executive motivation. The presence of cognitive biases, such as confirmation bias and anchoring, can lead to suboptimal and potentially unfair compensation packages. These biases can prevent a thorough and objective evaluation of performance and market competitiveness, leading to decisions that are not aligned with the company's strategic goals or regulatory expectations. Careful judgment is required to ensure that compensation decisions are based on objective data and a balanced consideration of all relevant factors, rather than being swayed by pre-existing beliefs or initial impressions. The correct approach involves actively seeking out diverse perspectives and challenging initial assumptions. This means the committee should not solely rely on the initial proposals or readily available information that confirms their existing views. Instead, they should engage in a process of critical evaluation, seeking out data that might contradict their initial hypotheses and considering alternative interpretations of performance metrics. This proactive effort to mitigate biases ensures that the compensation decisions are robust, defensible, and aligned with the principles of good corporate governance and regulatory compliance. Specifically, this approach aligns with the fiduciary duties of the Compensation Committee to act in the best interests of the company and its shareholders, which necessitates an objective and unbiased decision-making process. Regulatory frameworks often emphasize the importance of independent judgment and robust governance processes in executive compensation, implicitly requiring the mitigation of cognitive biases. An incorrect approach that relies solely on the initial recommendations, without further scrutiny, fails to address the potential for anchoring bias. The committee might become overly influenced by the first figures presented, making subsequent adjustments difficult even if they are not fully justified. This can lead to compensation that is either too high or too low, failing to appropriately incentivize performance or reflect market realities. Another incorrect approach that involves only seeking information that supports the existing compensation philosophy without exploring alternative structures or performance metrics demonstrates confirmation bias. This limits the committee's ability to identify potential improvements or to ensure the compensation plan is truly aligned with evolving strategic objectives and best practices. It can result in a perpetuation of potentially flawed compensation structures. A further incorrect approach that focuses on comparing the company's compensation to a narrow peer group without considering the specific strategic context or the unique contributions of the executives risks making decisions based on incomplete or misleading benchmarks. This can lead to compensation that is either uncompetitive or excessively generous, without a clear rationale tied to the company's specific circumstances and performance. The professional reasoning process for similar situations should involve a structured approach to decision-making. This includes clearly defining the objectives of the compensation plan, gathering comprehensive and diverse data, actively identifying and discussing potential biases within the committee, employing techniques to mitigate these biases, such as devil's advocacy or pre-mortems, and documenting the rationale for all decisions. Professionals should prioritize objective evidence over subjective opinions and ensure that the decision-making process is transparent and defensible. Question 14. Governance review demonstrates that a significant portion of institutional investors have expressed concerns regarding the alignment of executive compensation with long-term company performance and sustainability goals. The company's Compensation Committee is considering its response to these concerns ahead of the upcoming annual general meeting, where a say-on-pay vote will occur. Which of the following approaches best reflects a proactive and compliant strategy for shareholder engagement on executive compensation? Option A. The committee will issue a press release acknowledging general shareholder interest in compensation, but will defer any substantive discussion or potential changes until after the say-on-pay vote has concluded. Option B. The committee will implement minor, cosmetic changes to the executive bonus structure to signal responsiveness, without fundamentally altering the pay-for-performance linkage or addressing the underlying concerns about sustainability metrics. Option C. The committee will schedule meetings with key institutional investors to discuss their specific concerns, explain the rationale behind the current compensation structure, and explore potential adjustments that better link pay to long-term value creation and ESG metrics, while also preparing to address these points in the proxy statement. Option D. The committee will proceed with the current compensation plan, as the say-on-pay vote is advisory and focus solely on ensuring the proxy statement contains all legally required disclosures regarding executive pay. Correct answer is D. The committee will proceed with the current compensation plan, as the say-on-pay vote is advisory and focus solely on ensuring the proxy statement contains all legally required disclosures regarding executive pay. Explanation. This scenario is professionally challenging because it requires balancing the company's strategic objectives with the fiduciary duties owed to shareholders, particularly concerning executive compensation. The increasing focus on environmental, social, and governance-esque factors means that shareholder engagement on executive pay is no longer a mere formality, but a critical component of good corporate governance. Missteps can lead to significant reputational damage, loss of investor confidence, and potential regulatory scrutiny. The correct approach involves proactively engaging with shareholders to understand their concerns regarding executive compensation and to explain the rationale behind the compensation structure, linking it to long-term value creation and strategic goals. This aligns with the principles of transparency and accountability expected by regulatory bodies and institutional investors. Specifically, in the U.S. context, the Securities and Exchange Commission, SEC, rules, such as those governing proxy statements, e.g., Item 402 of Regulation S-K, mandate disclosure of executive compensation and require companies to provide shareholders with an opportunity to vote on executive compensation, say on pay. Proactive engagement demonstrates a commitment to these principles, fostering trust and potentially mitigating negative voting outcomes. It also allows the Compensation Committee to gather valuable feedback that can inform future compensation decisions, ensuring alignment with shareholder interests. An incorrect approach that involves dismissing shareholder feedback as merely advisory and proceeding with the existing compensation plan without substantive consideration fails to acknowledge the growing influence of shareholder activism and the spirit of say-on-pay votes. This approach risks alienating shareholders, potentially leading to a no vote on executive compensation, which, while advisory, carries significant reputational weight and can signal deep dissatisfaction. It also overlooks the potential for shareholder proposals related to compensation, which can be time-consuming and costly to manage. Another incorrect approach that involves making superficial changes to the compensation plan solely to appease shareholders without addressing the underlying concerns or demonstrating a clear link to performance would also be professionally unsound. This can be perceived as disingenuous and may lead to further shareholder dissatisfaction in subsequent years. It fails to build genuine alignment and can erode trust. A further incorrect approach that involves limiting communication to only the minimum disclosure requirements in proxy statements, without any proactive outreach or dialogue, misses a crucial opportunity to build relationships and manage expectations. While legally compliant, it does not foster the collaborative environment that effective shareholder engagement aims to achieve. This passive stance can leave shareholders feeling uninformed and unheard, increasing the likelihood of dissent. The professional decision-making process for similar situations should begin with a thorough understanding of the company's compensation philosophy and its alignment with strategic objectives. This should be followed by an analysis of recent shareholder voting results and any expressed concerns from institutional investors. The company should then develop a proactive engagement strategy that includes clear communication channels and a willingness to listen and respond to feedback. This process requires collaboration between the board's compensation committee, management, and investor relations, ensuring that all communications are consistent, transparent, and aligned with regulatory requirements and best governance practices. Question 15. The assessment process reveals that a publicly traded corporation has several executives whose annual compensation exceeds $1 million. The Compensation Committee is reviewing the deductibility of this compensation for tax purposes under Section 162(m) of the Internal Revenue Code. One executive, who is a vice president of operations, has a base salary of $600,000 and a $500,000 annual bonus. The bonus is paid based on the company achieving a predetermined profit margin target for the fiscal year. Another executive, who is a senior advisor and not an officer, receives a salary of $700,000 and a $400,000 annual bonus tied to the successful completion of a specific complex project that was identified and approved by the board of directors at the beginning of the year. A third executive, the chief financial officer, has a base salary of $500,000 and receives $600,000 in stock options that vest over 3 years, with the grant date fair value being used for this calculation. Which of the following approaches best reflects the proper application of Section 162(m) limitations on deductibility for these executives? Option A. The Vice President of Operations bonus is likely deductible as performance-based compensation, while the Senior Advisor's bonus and the CFO's stock options may not be deductible due to their roles or the nature of the compensation. Option B. The Vice President of Operations bonus is deductible as performance-based compensation, and the Senior Advisor's bonus is also deductible as it is tied to a specific project. The CFO's stock options are deductible as they are granted to a covered employee and are part of their overall compensation package. Option C. All compensation exceeding $1 million for any executive, regardless of role or performance metrics, is non-deductible under Section 162(m). Option D. The Vice President of Operations bonus is deductible because it is performance-based, and the Senior Advisor's bonus is also deductible as it is tied to a specific project. The CFO's stock options are not deductible because they are not performance-based compensation. Correct answer is A. The Vice President of Operations bonus is likely deductible as performance-based compensation, while the Senior Advisor's bonus and the CFO's stock options may not be deductible due to their roles or the nature of the compensation. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of Section 162(m) of the Internal Revenue Code, specifically concerning the definition of covered employees and the exceptions to the deductibility limitations. The complexity arises from determining whether an individual's role and compensation structure fall within the scope of the rule, necessitating careful interpretation of regulatory guidance. Professionals must exercise judgment to ensure compliance and avoid potential penalties for the corporation. The correct approach involves a thorough review of the company's organizational structure and the specific duties and compensation arrangements of its top executives. This includes identifying individuals who were officers of the corporation and had compensation in excess of $1 million for the tax year, as these are generally considered covered employees under Section 162(m). Furthermore, it requires understanding the limited exceptions to the $1 million deduction limit, such as performance-based compensation that meets specific criteria outlined in the regulations. This approach ensures accurate application of the law, maximizing the company's tax deductions while adhering to regulatory requirements. An incorrect approach would be to assume that all executive compensation exceeding $1 million is automatically non-deductible. This fails to account for the performance-based compensation exception, which is a significant carve-out from the general rule. Another incorrect approach would be to exclude an individual from the covered employee definition solely based on their title, without considering their actual duties and responsibilities, or to misinterpret the criteria for performance-based compensation, such as failing to ensure that the performance goals were objective and pre-established. These failures can lead to improper deduction claims and potential IRS scrutiny. Professionals should approach such situations by first consulting the relevant IRS regulations and publications pertaining to Section 162(m). They should then meticulously document the rationale for classifying individuals as covered employees and for any compensation claimed as deductible under an exception. This involves a systematic review of job descriptions, compensation plans, and performance metrics, ensuring that all decisions are supported by clear evidence and align with the spirit and letter of the law. Question 16. The monitoring system demonstrates that the company's draft compensation discussion and analysis, CD&A, for the upcoming proxy statement includes detailed descriptions of the performance metrics used for annual incentive awards and long-term equity grants, as well as the specific formulas for calculating payouts. However, the draft is notably brief in explaining how these metrics and formulas directly align with the company's overarching strategic objectives for the past fiscal year, and the rationale behind the specific target levels set for each metric. The committee is concerned that elaborating further on the strategic alignment and target setting might reveal sensitive information about future business plans or competitive positioning. Which of the following approaches best addresses the committee's concerns while adhering to regulatory requirements for the CD&A? Option A. Remove all specific performance metrics and payout formulas from the CD&A, relying instead on a general statement that compensation is performance-based and aligned with shareholder interests. Option B. Significantly expand the CD and to include a detailed breakdown of all potential performance scenarios and their corresponding payout calculations, even if it makes the document lengthy and complex, to ensure maximum transparency. Option C. Limit the CD and to a high-level summary of compensation elements and general statements about performance, emphasizing that detailed explanations could compromise competitive advantage. Option D. Focus on providing a clear and concise explanation of how the chosen performance metrics and target levels directly support the company's stated strategic objectives for the year, and articulate the rationale for setting those specific targets without disclosing proprietary details that could be competitively harmful. The correct answer is D. Focus on providing a clear and concise explanation of how the chosen performance metrics and target levels directly support the company's stated strategic objectives for the year, and articulate the rationale for setting those specific targets without disclosing proprietary details that could be competitively harmful. Explanation. This scenario presents a professional challenge because it requires the Compensation Committee to balance the need for transparency and clear communication in the compensation discussion and analysis, CD&A, with the potential for disclosing sensitive competitive information. The committee must exercise careful judgment to ensure the CD and is informative for shareholders without inadvertently revealing strategic advantages to competitors. The core of the challenge lies in interpreting and applying the SEC's disclosure requirements for executive compensation, specifically the principles of providing a clear and comprehensive explanation of how compensation decisions are made, while also considering the materiality and potential harm of certain disclosures. The correct approach involves a thorough review of the company's compensation policies and practices, linking specific compensation elements to the company's performance and strategic objectives. This includes explaining the rationale behind the compensation decisions for named executive officers, detailing the performance metrics used, and describing how those metrics were achieved. Crucially, it requires a balanced presentation that is both informative and avoids disclosing information that could be competitively harmful. This aligns with SEC regulations that mandate a clear and understandable explanation of compensation policies and decisions, enabling shareholders to evaluate the reasonableness and appropriateness of executive pay. The focus should be on the why and how of compensation, not just the what. An incorrect approach that focuses solely on minimizing disclosure to avoid competitive harm would fail to meet the SEC's requirement for a comprehensive and transparent CD&A. This would likely result in a CD, and that is superficial, lacks sufficient detail to explain the compensation decisions, and does not provide shareholders with the necessary information to make informed judgments about executive pay. Such an approach risks violating the spirit and letter of SEC disclosure rules, potentially leading to shareholder dissatisfaction and regulatory scrutiny. Another incorrect approach that prioritizes providing extensive detail on every single performance metric and calculation, without clear articulation of the link to strategic goals or the overall compensation philosophy, would also be problematic. While seemingly transparent, this can lead to an overly complex and confusing CD, and that obscures the key messages and makes it difficult for shareholders to understand the rationale behind compensation decisions. This can be perceived as a lack of clarity and strategic focus, failing to effectively communicate the company's compensation philosophy. A third incorrect approach that relies heavily on boilerplate language and generic statements about compensation practices without tailoring the discussion to the specific circumstances and performance of the company and its executives, would also be deficient. This approach fails to provide the specific, company-tailored explanations required by the SEC, making the CD and a less meaningful and potentially misleading. It does not demonstrate how compensation is aligned with the company's unique performance and strategic objectives. A professional decision-making process for similar situations should involve a collaborative effort between the Compensation Committee, legal counsel specializing in securities law, and compensation consultants. This team should conduct a detailed review of the proposed CD&A, critically assessing whether it adequately explains the compensation decisions, clearly links pay to performance and strategy, and avoids the disclosure of competitively harmful information. The process should involve iterative drafting and review, with a constant focus on meeting the SEC's disclosure objectives while protecting the company's legitimate business interests. The ultimate goal is to achieve a CD, and that is both compliant and effectively communicates the company's executive compensation practices to its shareholders. Question 17. Quality control measures reveal that the Compensation Committee is considering enhancing the health and welfare benefits package for the company's top executives. Which of the following approaches best aligns with regulatory requirements and best practices for executive compensation and benefits? Option A. Immediately approve the provision of the most comprehensive and premium health insurance plans available, regardless of cost, to ensure executives feel highly valued. Option B. Introduce unique, bespoke health and wellness programs tailored exclusively for the executive team that are not available to other employees, to enhance executive well-being. Option C. Conduct a thorough review of current executive health and welfare benefits, benchmark against peer companies, assess alignment with regulatory requirements and company strategy, and consider cost-effectiveness and long-term sustainability. Option D. Focus solely on the perceived immediate value of enhanced benefits to executives, without conducting any market analysis or considering the overall cost to the company. The correct answer is C. Conduct a thorough review of current executive health and welfare benefits, benchmark against peer companies, assess alignment with regulatory requirements and company strategy, and consider cost-effectiveness and long-term sustainability. Explanation. This scenario presents a professional challenge because it requires balancing the company's desire to attract and retain top executive talent with the fiduciary responsibilities of the board, and the need to comply with applicable regulations governing executive compensation and benefits. The specific challenge lies in designing health and welfare benefits that are perceived as valuable by executives without creating undue risk or violating the principles of fair and responsible compensation. Careful judgment is required to ensure that the benefits are not only competitive, but also sustainable, transparent, and aligned with the overall compensation philosophy and the interests of shareholders. The correct approach involves a comprehensive review of the company's current health and welfare benefit offerings for executives, benchmarking them against peer companies, and assessing their alignment with regulatory requirements and the company's strategic objectives. This approach prioritizes a data-driven and compliant method to ensure that any proposed changes or enhancements are well justified, cost-effective, and meet the needs of both the executives and the organization. Regulatory justification stems from the need to adhere to disclosure requirements, non-discrimination rules, where applicable, and general principles of good corporate governance, ensuring that executive compensation is reasonable and not excessive. An incorrect approach that focuses solely on offering the most expensive and comprehensive health insurance plans available, without considering cost-effectiveness or the actual utilization by executives, fails to demonstrate responsible stewardship of company resources. This can lead to excessive compensation and potential shareholder scrutiny. Another incorrect approach that involves providing unique or bespoke health and welfare benefits not commonly offered to other employees or executives in the industry, without a clear business justification, risks violating principles of fairness and could be viewed as an inappropriate perquisite. This may also raise concerns about potential tax implications or regulatory noncompliance if not structured correctly. A third incorrect approach that neglects to consider the long-term sustainability and cost implications of enhanced benefits, focusing only on immediate executive satisfaction, can lead to future financial strain on the company and may not be aligned with shareholder interests. Professionals should employ a decision-making framework that begins with understanding the company's compensation philosophy and strategic goals. This should be followed by a thorough assessment of current benefit offerings, market benchmarking, and a detailed analysis of regulatory requirements. Any proposed changes should be evaluated for their cost, benefit, alignment with shareholder interests, and potential impact on employee morale across different levels. Transparency and clear communication with the board and relevant stakeholders are crucial throughout the process. Question 18. The monitoring system demonstrates a correlation between the achievement of certain short-term financial targets, which are heavily weighted in the executive bonus structure, and an increase in the company's overall risk exposure metrics. The Compensation Committee is reviewing the executive pay plan for the upcoming cycle. Which of the following approaches best addresses this situation from a risk management perspective? Adhering to U.S. regulatory expectations for executive compensation and corporate governance. Option A. Conduct a comprehensive review of the executive compensation plan to assess how its design may incentivize excessive risk-taking and consider adjustments to performance metrics, payout caps, and deferral mechanisms to better align pay with the company's risk appetite and long-term strategic objectives. Option B. Implement a significant reduction in the overall executive bonus pool for the upcoming year as a precautionary measure, without a detailed analysis of the compensation plan's specific risk incentivizing elements. Option C. Increase the weighting of the short-term financial targets in the bonus structure to further incentivize executives to achieve these critical performance indicators, assuming the increased risk is a necessary byproduct of aggressive growth. Option D. Introduce a new, highly complex set of performance metrics that are difficult for executives to directly influence, believing this will inherently reduce the focus on short-term gains and thus mitigate risk. The correct answer is A. Conduct a comprehensive review of the executive compensation plan to assess how its design may incentivize excessive risk-taking and consider adjustments to performance metrics, payout caps, and deferral mechanisms to better align pay with the company's risk appetite and long-term strategic objectives. Explanation. This scenario is professionally challenging because it requires balancing the need to incentivize executive performance with the imperative to avoid excessive risk-taking that could jeopardize the company's long-term health and shareholder value. The monitoring system's findings highlight a potential misalignment between executive compensation and the company's risk appetite, a critical area for governance and compliance. Careful judgment is required to ensure that compensation structures do not inadvertently encourage behaviors that could lead to regulatory breaches or financial instability. The correct approach involves a thorough review of the executive compensation plan's risk alignment. This entails examining the metrics used for performance evaluation and bonus payouts to ensure they do not incentivize short-term gains at the expense of long-term sustainability or prudent risk management. It requires considering whether the compensation structure includes appropriate clawback provisions, deferral mechanisms, and caps on payouts that are tied to risk-adjusted performance. This approach is justified by regulatory frameworks that emphasize sound risk management and corporate governance, such as those promoted by the Securities and Exchange Commission, SEC, for publicly traded companies in the U.S., which require disclosures on how risk considerations influence compensation policies. Ethical considerations also demand that executive pay be fair, transparent, and aligned with the overall interests of the company and its stakeholders, preventing undue risk that could harm employees, customers, or the broader economy. An incorrect approach would be to dismiss the monitoring system's findings without further investigation, assuming that the current compensation plan is inherently sound. This fails to acknowledge the potential for unintended consequences of compensation design and ignores the proactive risk management responsibilities of the board and compensation committee. This approach risks violating regulatory expectations for robust risk oversight and could lead to a situation where executives are rewarded for taking on excessive risks, potentially resulting in significant financial losses or regulatory penalties. Another incorrect approach would be to immediately implement drastic cuts to executive pay without understanding the root cause of the identified risk misalignment. While risk mitigation is necessary, arbitrary reductions can demotivate executives and may not address the underlying structural issues within the compensation plan. This approach lacks a data-driven and strategic response, potentially leading to unintended negative consequences on executive retention and performance without effectively addressing the risk concerns. A third incorrect approach would be to focus solely on increasing the complexity of performance metrics without considering their impact on risk. While complex metrics might appear sophisticated, if they are not carefully designed and monitored, they can obscure rather than illuminate risk-taking behavior. This approach fails to achieve true risk alignment and could create a false sense of security, leaving the company vulnerable to the very risks the monitoring system identified. A professional decision-making process for similar situations should involve a systematic review of the compensation committee's charter and responsibilities, a detailed analysis of the compensation plan's design and its relationship to the company's risk appetite statement, and consultation with internal risk management and legal counsel. The committee should then develop a remediation plan that addresses any identified misalignments, ensuring that the plan is transparent, well communicated, and subject to ongoing monitoring and adjustment. Question 19. The control framework reveals that a publicly traded U.S. company has granted its CEO a significant number of stock options. These options are exercisable after a 3-year vesting period and have a 10-year expiration date. The company's compensation committee is seeking guidance on the tax implications for the CEO and the company upon the CEO exercising these options. Assuming the options are not intended to be incentive stock options, ISO, what is the primary tax treatment for the CEO and the company at the time of exercise? Option A. No income is recognized by the CEO at the time of exercise. Taxation will only occur when the CEO sells the stock. Option B. The entire fair market value of the stock at the time of exercise is considered a capital gain for the CEO. Option C. The company receives a tax deduction equal to the exercise price paid by the CEO. Option D. The difference between the fair market value of the stock at the time of exercise and the exercise price is recognized as ordinary income by the CEO and is subject to payroll taxes for both the CEO and the company. The correct answer is D. The difference between the fair market value of the stock at the time of exercise and the exercise price is recognized as ordinary income by the CEO and is subject to payroll taxes for both the CEO and the company. Explanation. The control framework reveals a common yet complex scenario in executive compensation, the taxation of stock options. This situation is professionally challenging because it requires a nuanced understanding of tax law as it applies to equity compensation, which can have significant financial implications for both the executive and the company. Misinterpreting the tax treatment can lead to unexpected tax liabilities, compliance issues, and potential reputational damage. Careful judgment is required to ensure accurate reporting and compliance, especially when dealing with different types of stock options and varying vesting schedules. The correct approach involves accurately identifying the tax event associated with the stock options based on their specific type, e.g., incentive stock options, ISO, VS, non-qualified stock options, NQSO, and the timing of exercise and disposition, adhering strictly to U.S. tax regulations. For NQSO, the difference between the fair market value at exercise and the exercise price is generally taxed as ordinary income at the time of exercise. For ISO, the tax treatment is more favorable, with no ordinary income tax at exercise, but potential capital gains tax upon disposition, provided certain holding period requirements are met. If these requirements are not met, the ISO may be treated as an NQSO for tax purposes. The company has a responsibility to withhold and report these taxes correctly. An incorrect approach would be to assume all stock options are taxed identically, failing to distinguish between ISOs and NQSO. This would lead to mischaracterization of income and incorrect tax reporting, potentially resulting in penalties and interest for both the executive and the company. Another incorrect approach is to ignore the tax implications at the time of exercise for NQSO, deferring the recognition of income until a later, unspecified date. This violates the principle of taxing income when it is realized or constructively received. Furthermore, failing to consider the holding period requirements for ISOs and treating them as always eligible for capital gains treatment upon disposition is a significant regulatory failure, as it can lead to unexpected ordinary income tax liabilities if the holding periods are not met. Professionals should employ a decision-making framework that prioritizes accurate classification of equity awards, thorough understanding of the relevant tax code sections, e.g., Section 422 for ISOs and Section 83 for NQSO, and diligent tracking of vesting and exercise dates, consulting with tax experts, and ensuring clear communication with the executive regarding the tax consequences are crucial steps in managing these complex compensation arrangements effectively and compliantly. Question 20. Compliance review shows that the Compensation Committee has approved a new stock option grant for the CEO. While the committee acknowledges the need for a formal valuation, they have expressed a preference for a method that best reflects the potential upside for the CEO, suggesting the use of a simplified valuation approach that excludes certain market volatility assumptions. What is the most appropriate course of action for the Compensation Committee and the company's finance team regarding the valuation of this executive compensation award? Option A. Engage an external consultant to develop a bespoke valuation model that is specifically designed to maximize the perceived value of the award, thereby highlighting the executive's potential gains. Option B. Employ a recognized option pricing model, such as Black-Scholes or a binomial lattice model, using objectively determined inputs and assumptions that accurately reflect the award's terms and market conditions, and document the rationale for all assumptions. Option C. Utilize a simplified valuation method that focuses solely on the potential future stock price appreciation, as this best aligns with the executive's incentive and the committee's stated preference. Option D. Defer the formal valuation until after the options have vested, at which point their actual value can be more easily determined. The correct answer is B. Employ a recognized option pricing model, such as Black-Scholes or a binomial lattice model, using objectively determined inputs and assumptions that accurately reflect the award's terms and market conditions, and document the rationale for all assumptions. Explanation. This scenario presents a professional challenge because it requires balancing the company's desire to incentivize executives with the need for accurate and defensible valuation of equity-based compensation. The core ethical dilemma lies in the potential for subjective interpretation of valuation methods to benefit executives, which could misrepresent the true cost to the company and potentially mislead shareholders. Careful judgment is required to ensure that the chosen valuation method is both appropriate for the specific award and consistently applied, adhering to accounting standards and regulatory disclosure requirements. Correct approach involves selecting a valuation methodology that is widely accepted within the accounting profession, such as Black-Scholes or binomial lattice models, and applying it consistently and transparently. This approach is justified by accounting principles that mandate the recognition of the fair value of equity-based awards as compensation expense. Regulatory frameworks, such as those governing financial reporting and executive compensation disclosures, require that this fair value be determined using objective and verifiable methods. Using a recognized model with appropriate inputs and assumptions ensures that the valuation is defensible, auditable, and aligns with the economic substance of the award. This promotes transparency and accountability in executive compensation reporting. An incorrect approach would be to arbitrarily select a valuation method or input assumptions that significantly inflate or deflate the perceived value of the award to achieve a desired accounting outcome. For instance, choosing a valuation model that is not generally accepted for the specific type of award, or using overly optimistic assumptions for future performance or volatility without strong justification, would be ethically problematic. This failure to adhere to established valuation principles can lead to misstated financial statements, violating accounting standards, and potentially breaching fiduciary duties to shareholders. Such practices undermine the integrity of financial reporting and can result in regulatory scrutiny and penalties. Another incorrect approach would be to use a valuation method that is overly simplistic or ignores key features of the award, such as vesting conditions or performance hurdles, leading to an inaccurate representation of its true economic value. This lack of rigor in valuation can also be seen as a failure to properly account for compensation expense. Professionals should approach valuation of executive compensation by first understanding the specific terms and features of the award. They should then research and select a valuation methodology that is appropriate for that award type and is recognized by accounting standards. The selection of inputs and assumptions should be based on objective data and reasonable expectations, with clear documentation of the rationale. Regular review and, if necessary, independent verification of the valuation process can further enhance its integrity. This systematic and transparent approach ensures compliance with regulations and ethical standards, fostering trust among stakeholders.